and welcome to Closing Bell with me, Nandita Khemka. Well, last hour of trade and the Nifty is nearly at the high point of the day, trading above that 18,100 mark. What's aiding sentiment is the metals pack. That is the biggest gainer in today's session. Stocks like Hindalco, JSW Steel, Tata Steel among the top gainers. Even Tata Motors is extending its gains. If you look at ONGC, Asian Paints, some of the top gainers on the Nifty. Well, but without any delay, let's get our guest on board and figure out whether or not the Nifty is poised to end 2022 above that 18,000 mark. Joining me now is Rahul Arora, who's the CEO of Nirmal Bang Institutional Equities. Rahul, good to have you on the show. Looks like the Nifty is poised to end the year above that 18,000 mark. If you look at last week, we saw 4 consecutive days of sell-off coming in, but yesterday, most of Friday's gains, in fact, Friday's losses were wiped out, and looks like we are poised to end the day on a year on a positive note above that 18,000 mark. What are your thoughts on the same?
Thank you for having me in your show, Nandita. So yeah, I think obviously, there was a bit of a global scare last week with respect to COVID and what was happening in China. But I think a lot of the data points and the noises over the weekend from various medical authorities in India putting to rest some of those concerns have helped the markets rally over the last couple of days. But I think these are transient factors, Nandita. I think as you look ahead to 2023, we still have to feel the full economic impact of the interest rate hikes that the US Fed and the RBI have done. And I think, we are definitely heading into a year of a slowdown / recession in many parts of the global economies. So even though it looks nice to see 19,000 on the Nifty as we are closing out the year, I think the best approach would be to be a bit cautious, to diversify your risks, because, you do have fixed income that's appearing to be a good alternate asset class as we speak. And to moderate, or should I say temper your expectations from the market going into next year. It's been a good run for the markets, even though the headline index has been flat, from last October, November till now. But I think lots of stock-specific opportunities have been there and monies have been made. But we just need to calibrate our expectations a bit going into a year where, there are going to be visible signs of a slowdown both in India and overseas.
Sure. Getting into some of the sectors and stocks now, what are your thoughts on the entire banking pack? We've seen the PSU bank stage a stellar run. The likes of mid-cap stocks like Canara Bank, Bank of India, all of these have had a stellar run over the last few weeks, if I may say so. Most analysts are of the view that the worst is over when it comes to asset quality for these banks. But valuation-wise, do you think these stocks have run up ahead of themselves?
So, two-part answer to that, Nandita. I think the one is obviously on the PSU side, as you rightly mentioned, there was a huge valuation differential between the private sector peers that they had. And to that extent, there were good trades. It was a trade in, trade out. I don't think too many of these PSU banks, barring the top 3, 4, actually make for core institutional holding for a lot of institutional investors. These are pure intra-quarter trades, if you will, where you'll probably hold them for 3, 4 weeks, make 50 to 100% and trade yourself out. The other issue, of course, is a slightly longer term issue. And as you said, while the asset quality situation is looking like it's getting a lot better, we need to keep in mind 2 things. One is deposit growth, which has been a challenge for banks in India. And we're seeing that deposit rates are rising. This will put pressure on net interest margins, net of the book that's even linked to the EBLR. The other, of course, is credit growth, which is currently hovering at 16, 17%. If we're heading into a year which is going to be a year of slowdown, and if that number gets revised down, say from 16, 17 to 12, 13%, and on top of that, you have a little bit of net interest margin compression, I'm not sure whether there is a direct trade from here to 50,000 or even north of that on the bank Nifty. So I think case to case basis, yes, banks will do well. I think if you must make an investment in this sector, especially at this juncture, I would say stick with the leaders, HDFC, ICICI, Kotak Mahindra Bank, Federal Bank, City Union Bank from the mid-cap space. These are some good names. I would probably be more aligned to stick with them than to take any risky bets, either through PSUs or what are perceived to be higher corporate sector lending entities on the private sector side. So I think it'll probably be the first 6 months of the year. Next year will probably be consolidation for the banks. But like I said, if you must be with anyone in the sector, predominantly be with the leaders in the large cap and the mid cap space.
I'll stick to the leaders when it comes to banks. That's the call. But Rahul, I want to stick to the rate sensitives and talk about the realty sector as well. In a rising rate environment, most of us thought that the December rate hike would be the last from the RBI, but it's clearly visible that the RBI governor is not in favor of a premature pause, and in fact, the doors are open for a 25 basis point rate hike once again in February going forward. So, in the wake of this, how do you view this entire realty basket going forward?
So I think if you listen to the industry veterans, right? I mean, Deepak Parekh, for example, just a few months back said that he had never seen the kind of real estate sales in his career as to what he saw in the 2 months of COVID. And a lot of that was people basically moving their residences and making offices out of them. So you had people who were buying 1, 2, 3 BHKs who are now starting to buy 1.5, 2.5, 3.5 BHKs. So I think the point here is that the replacement cycle of real estate is so large, right? Typically, when you buy a home, most people would buy a home once, maybe twice in their life, in their adult life. So I think a large part of that demand has probably been captured. I think the next leg will only come in through replacement and maybe, a lot of the people who are moving out into nuclear families. But I'm not sure whether that delta will be as high as what we've seen in the last couple of years. That being said, I'm not for a moment saying that we're negative on real estate. We do like a few real estate names like Prestige and Brigade, etc. But I think they will be on a case-to-case basis. Like you said, with the rising cost of capital and lending rates going up, with people's personal P&Ls and balance sheets to take a relook at, and of course the cost of the EMI is going up, there will be a resultant impact on the loans and therefore even actually purchasing the asset. But like I said, I don't think the next couple of years will be as gung-ho as you've seen during the COVID period, where companies actually started reporting some very decent cash flows as well. So I think stick with marquee names. You might also consider an investment into REITs, real estate investment trusts. You do have a couple of them listed in India, so that may actually not be a bad way to be playing the real estate sector. Instead of buying out and out real estate stocks, you could potentially look at REITs as an asset class and look at buying some of those as well.
Sure. Look at REITs as well. That's the call. That's the word from Rahul, rather. Rahul, I also want to talk about the IT stocks. Recessionary fears in the US, slowdown in discretionary spending, cautious guidance from Accenture. In fact, even HCL Tech has revised its guidance to a lower end of the band. So, in light of all this, do you still feel that IT could be a compelling buy? Because maybe the second half of the next year would be better going forward for these companies.
So I think you've hit on the two most important data points that the IT sector has seen over the last fortnight in India, which is the Accenture results and more importantly, what HCL Tech has called out. Our sense is, and my head of research has been writing extensively about this, is that this may actually get more pronounced over the next 3 to 4 months. So it is very possible that when the IT companies declare their results in about 10, 15, 20 days from now, you may start seeing very similar kinds of commentary. And if not in this quarter, it's very possible that by the middle of this quarter or earliest by April, May, you'll probably hear some alarm bells that are coming out from the IT sector. Fantastic sector overall structurally, but our sense is that the time to buy it is still some way away. So even today, we do believe for the growth rates that are being projected, the street is a little too optimistic. We're obviously undershooting the street by 200 to 300 basis points in terms of headline growth. The only thing, of course, going in favor of the IT companies is that the rupee has depreciated quite substantially year on year. So to that effect, there'll be a tailwind and we'll have to weigh out the cross-currency impact. But you don't technically buy companies to play currency and currency swings. You can do that in the currency market as it is. So I think growth in the short term may be a challenge. A lot of the total contract values that a lot of the IT companies have got, there is a good chance that they may get deferred by a quarter or two. Nobody's talking about order cancellations here. But even though we remain structurally constructive on this sector, I think there'll probably be a period of transient pain over the next 4 to 6 months. And I think the opportunity to buy it may be either mid-quarter, that is say around February, March, or then maybe at the end of the quarter when they declare the results around April, May.
Right, Laura, I also want to get in your view on these new age tech companies. We saw Nykaa bonus issue, the Paytm buyback. These really failed to stem the losses on the shares of these companies. Going forward, do you think that these companies have, in fact, these shares have seen the worst in terms of correction, and now maybe these are fairly valued, and people can actually look into buying some of these counters?
Look, when the going is good, all bets are off, right? So a lot of these companies listed when the interest rate environment was benign, liquidity was in abundance, and things were gung-ho, and all kinds of valuations were coming in. People started focusing on terminologies like client acquisition, gross merchandise value, price to sales, things like you would never hear Indian investors, forget institutional, even retail would never be talking about that. Uh, my sense is it's returned more back to the conventional way where people are looking at profits, return on equity, return on capital employed, return on invested capital, and trying to ascribe a value to that. To that extent, I think any company that is demonstrating a road to profitability need not necessarily be profitable. But if this is a road to profitability, I think the market will take kindly to it. But if it's going to be something where the company is going to keep coming back to the market to fund its losses or diversify beyond its means, I think there are going to be challenges. For a lot of these companies that listed over the last couple of years, I think maybe 70% of them would still be trades. I think a lot of the investors who have invested in these stocks are still looking for exit options because of the losses. I think there is a case for about 25-30% of these making it into the core holding, but these are very situational. I think from time to time you will get opportunities to play these stocks for a 20, 30, 40% pop. But I would say just trade in and trade out if you can make your money. But it's essentially gone back, and you can see that in the kind of companies as well, Nandita, that are coming out for IPOs. The IPOs over the last 6 to 8 months are very different from what were coming out 15 months back. These are all profitable, interesting niche areas, and they're getting very, very well subscribed. And I think they'll probably continue to do well. So just be a little cautious, focus on profitability or a road to profitability, and focus on return ratios. If all things tick your boxes, then by all means you can make it a core holding in your portfolio. Otherwise, like I said, at best it'd probably be trading bets.
Probably be trading bets. But Rahul, leave us with one theme that you feel will do extremely well in the coming year.
In the coming year, that's from a 1 year time horizon, you say?
1 to 2 year time horizon.
So I think, Nanda, because we're getting into a pre-election year, I think government spending is probably going to pick up in a fairly material way. I think you're going to see a lot of announcements to the effect of roads, ports, highways, bridges, etc. So I would place cement as a second-order beneficiary. I think, typically cement demand tends to grow at 1.2 to 1.5 times GDP growth. And if cost pressures ease out, then you could land up seeing a little bit of uptick on the margins as well. So I think cement could probably be a very interesting theme to play. And within that, depending on where you straddle the market cap ladder, you could look at Ultratech in the large cap space, something like a Nuvoco in the mid caps, and maybe a JK Lakshmi in the small cap space. So I think probably the big dominant theme for me over the next 1 year would be cement.
Well, cement seems to be Rahul's favorite theme for the next year. Well, with that, Rahul, thanks a lot for taking out time and joining in this afternoon. Wish you a very happy new year and a profitable one at that.
Thank you so much for having me and wish you the same.
Thank you. Thanks a lot. All right, on the high point of the day, Nifty above that 18,100 mark. Metals, of course, ruling the roost this afternoon. With that, it's a wrap on this edition of Closing Bell, but stay tuned to Money Control for more news and updates.